Single-step income statement. An income statement that shows only one step in determining net income. Sales revenue. The primary source of revenue in a merchandising company. Sales returns and allowances. Purchase returns and allowances from the seller's perspective. Sales invoice. A document that supports each credit sale. Sales discount. A reduction given by a seller for prompt payment of a credit sale. Purchase return. Return of goods from the buyer to the seller for a cash or credit refund. Purchase invoice. A document that supports each credit purchase. Purchase discount. A cash discount claimed by a buyer for prompt payment of a balance due. Purchase allowance. A deduction made to the selling price of merchandise, granted by the seller so that the buyer will keep the merchandise. Perpetual inventory system. An inventory system under which the company keeps detailed records of the cost of each inventory, purchase and sale, and the records continuously show the inventory that should be on hand. Periodic inventory system. An inventory system under which the company does not keep detailed inventory records throughout the accounting period but determines the cost of goods sold only at the end of an accounting period. Other revenues and gain. A non-operating activities section of the income statement that shows revenues and gains unrelated to the company's main line of operations. Other expenses and loss. A non-operating activities section of the income statement that shows expenses and losses unrelated to the company's main line of operations. Operating expenses. Expenses incurred in the process of earning sales revenues. Non-operating activities. Various revenues, expenses, gains, and losses that are unrelated to a company's main line of operations. Net sales. Sales less sales returns and allowances and less sales discounts. Multiple-step income statement. An income statement that shows several steps in determining net income. Income from operations. Income from a company's principal operating activity, determined by subtracting cost of goods sold and operating expenses from net sales. Gross profit rate. Gross profit expressed as a percentage, by dividing the amount of gross profit by net sales. Gross profit. The excess of net sales over the cost of goods sold. FOB shipping point. Freight terms indicating that the seller places goods free on board the carrier, and the buyer pays the freight costs. FOB destination. Freight terms indicating that the seller places the goods free on board to the buyer's place of business, and the seller pays the freight. Cost of goods sold. The total cost of merchandise sold during the period. Contra revenue account. An account that is offset against the revenue account on the income statement. Contra revenue. Account category of sales discounts. Contra revenue. Account category of sales returns and allowances. Retailers. Merchandising companies that purchase and sell directly to consumers. Wholesalers. Merchandising companies that sell to retailers. To determine the cost of goods sold under a periodic inventory system, the following steps are necessary. 1. Determine the cost of goods on hand at the beginning of the accounting period. 2. Add to it the cost of goods purchased. 3. Subtract the cost of goods on hand at the end of the accounting period. True. To determine the cost of goods sold under a periodic inventory system, the following steps are necessary. 1. Determine the cost of goods on hand at the beginning of the accounting period. 2. Subtract the cost of goods on hand at the end of the accounting period. 3. Add to it the cost of goods purchased. False. To determine the cost of goods sold under a periodic inventory system, the following steps are necessary. 1. Add to it the cost of goods purchased. 2. Determine the cost of goods on hand at the beginning of the accounting period. 3. Subtract the cost of goods on hand at the end of the accounting period. False. To determine the cost of goods sold under a periodic inventory system, the following steps are necessary. 1. Add to it the cost of goods purchased. 2. Subtract the cost of goods on hand at the end of the accounting period. 3. Determine the cost of goods on hand at the beginning of the accounting period. False. Giovanni Company buys merchandise on account from Gordon Company. Journal entry for Giovanni's Company. Debit inventory and credit accounts payable. Giovanni Company buys merchandise on account from Gordon Company. The selling price of the goods is $708 and the cost of the goods is $560. Record credit sale. Debit accounts receivable and credit sales revenue for $780. Giovanni Company buys merchandise on account from Gordon Company. The selling price of the goods is $708 and the cost of the goods is $560. Record cost of merchandise sold. Debit cost of goods sold and credit inventory for $560. To record merchandise returned to our company. Debit sales returns and allowances and credit accounts receivable. To record cost of merchandise returned. Debit inventory and credit cost of goods sold. To record cash received from another company for the balance due of merchandise sold with discount. Debit cash and sales discounts, credit accounts receivable. Gross profit will result if sales revenues are greater than cost of goods sold. Under a perpetual inventory system, when goods are purchased for resale by a company, A. Purchases on account are debited to inventory. B. Purchases on account are debited to purchases. C. Purchase returns are debited to purchase returns and allowances. D. Freight costs are debited to freight out. Purchases on account are debited to purchases. The sales accounts that normally have a debit balance are sales discounts and sales returns and allowances. A credit sale of $750 is made on June 13, terms 2/10 net 30. A return of $50 is granted on June 16. The amount received as payment in full on June 23 is $686. Which of the following accounts will normally appear in the ledger of a merchandising company that uses a perpetual inventory system? Asterisk purchases, asterisk freight in, asterisk cost of goods sold, asterisk purchase discounts. Cost of goods sold. To record the sale of goods for cash and a perpetual inventory system, only one journal entry is necessary to record cost of goods sold and reduction of inventory. True. To record the sale of goods for cash and a perpetual inventory system, only one journal entry is necessary to record the receipt of cash and the sales revenue. False. To record the sale of goods for cash into Perpetual inventory system, 2 journal entries are necessary. 1 to record the receipt of cash and sales revenue, and 1 to record the cost of goods sold and reduction of inventory. False. To record the sale of goods for cash into Perpetual inventory system, 2 journal entries are necessary. 1 to record the receipt of cash and reduction of inventory, and 1 to record the cost of goods sold and sales revenue. False. The steps in the accounting cycle for a merchandising company are the same as those in a service company, except A. An additional adjusting journal entry for inventory may be needed in a merchandising company. B. Closing journal entries are not required for a merchandising company. C. A post-closing trial balance is not required for a merchandising company. D. A multiple-step income statement is required for a merchandising company. The multiple-step income statement for a merchandising company shows each of the following features, except gross profit, cost of goods sold, a sales revenue section, investing activities section. D. If sales revenues are $400,000, cost of goods sold is $310,000, and operating expenses are $60,000, the gross profit is $90,000. A single-step income statement reports gross profit, does not report cost of goods sold. Reports sales revenues and other revenues and gains in the revenues section of the income statement. Reports operating income separately. C. Which of the following appears on both a single-step and a multiple-step income statement? Inventory, gross profit, income from operations, cost of goods sold. Cost of goods sold. In determining cost of goods sold, purchase discounts are deducted from net purchases. Freight out is added to net purchases. Purchase returns and allowances are deducted from net purchases. Freight in is added to net purchases. D. If beginning inventory is $60,000, cost of goods purchased is $380,000, and ending inventory is $50,000, cost of goods sold is $390,000. When goods are purchased for resale by a company using a periodic inventory system, purchases on account are debited to purchases. In a worksheet, inventory is shown in the following columns. Adjusted trial balance debit and balance sheet debit. The key components of this statement are net sales, cost of goods sold, gross profit, total operating expenses, and net income. Income statement is so named because it shows several steps in determining net income. Two of these steps relate to the company's principal operating activities, also distinguishes between operating and non-operating activities. Finally, the statement also highlights intermediate components of income and shows subgroupings of expenses. Multiple step statement